Hi, welcome to Family Office World Live. I love doing this, and I particularly love the episode we're going to have today because we're doing it with a good friend. But he's somebody who's been very instrumental in the family office space with what he's created at Booth. So first, what I'd like to do is Steve Kaplan is probably the top professor, I would argue, in the country in private equity and private markets. He's been doing it since before the industry even started. And today, what I want to talk about are three things actually. One, his favorite topic, which is private equity. Two, my favorite topic, which is family offices. And then three, the family office initiative that he and I and Paul Carbone and a few other people are putting together at the University of Chicago Booth, and how I think that's going to transform a lot of the family office industry. So, Steve, it's wonderful to see you, and thank you very much for coming.
Great. It is a pleasure to be here, Ron.
All right, first let's talk background, because I hear the word private equity, I think Steve Kaplan. That's the way my weird mind works. You were in the space before it was a space. Talk just for the audience, because not everybody knows who you are. Take a minute, if you would, and just a little bit about your background and how you got into the space.
So it's very funny, and it involves your father too, as you know. I started studying. I started studying private equity and leverage buyouts in the 80s. So I was a PhD student at Harvard Business School, working with Mike Jensen. And in the 80s, leverage buyouts were a new thing. They were controversial then. I guess some things never change. And people, wanted to understand, were they, doing anything with the companies? Were they, because they were very successful in the first half of the 80s. And people said, were they just buying stuff cheap? Were they changing the companies? Was it taxes? What was going on? And that was a great thing to study as an academic, because there were theoretical reasons to believe, various different things. And it was really an empirical question, what was going on. And I was like, the first person to study leverage buyouts empirically. And that was, back in the 80s. And what I found at that point was that the private equity firms, or the LBOs, actually made the companies more efficient. Their margins went up and their cash flows went up. And that was, a good part of the reason that the buyouts were very successful in the 80s when they started. And then, over time, I've continued studying them, and the data was really hard to get data in the 80s. Over time, better data has become available. And, as the data have become available, I've, continued to study buyouts.
So, did you have any clue when you started that this industry would become as massive as it has become? Because when you were there, it didn't even exist. It was called leverage buyouts.
No, zero. I mean, I would say I got some things right. I got plenty of things wrong. And so what was right, I think, is that the leverage buyouts, and they changed their name to private equity after there were a lot of leverage buyouts that defaulted and went bankrupt in the early 90s because they over leveraged the companies in the late 80s. And that's when they changed the name to private equity. And it was really out of favor in the mid 90s. I mean, some people thought it was dead. And I think what is true, and was true then and is true today, is the private equity firms are really good at creating value, operational value. And that comes through, a combination of incentives that they give to management. And the incentives are much stronger than they are in a typical public company. They provide governance, and increasingly they provide operational help. And those things on average create value. And that's what we saw back in the 80s, and they've gotten better at that over time. I had no idea the industry would get so huge, and that it would also move, you have infrastructure, you have, I guess real estate is a little different, but it really has growth equity. So it's really, it started out as being really appropriate for companies that were kind of mature in wasting cash or not optimizing. And over time, it's become, I think, much more the places where you can use private equity, have become just broader. And so I got that completely. I would not have seen that, or I did not see that.
Yeah, it's remarkable how large the industry has gotten. Question, I guess, is what's driven the growth? So I used to run a hedge fund and deal with just public companies. And the problem with publicly traded companies, if you own a publicly traded widget company, and you've got to report to me or somebody on Wall Street every 90 days, you're managing your earnings. It's a hard way to do it. So is one of the reasons that private equity took off because it was a better model. 2% covered the overhead, right? Or supposed to cover the overhead. 20% I make money if you make money. And that's a better model than the publicly traded companies, which were basically every 90 days you've got to report to somebody. So you could do things more efficiently. Is that what drove it, or what else drove it?
I mean, it's there. There are many things. I think part of it again is that the private equity investors who are buying the company, they have control generally, they control the board, are paying attention, if not every day, very often how the company's going. So there's a lot of scrutiny on the company to make good decisions and increase value. Some public companies are well run, some not. So that's one factor. Factor number two, and the private equity firms, because their compensation is 2 and 20, that 20 is very motivating. They get 20% of the profits. So that's one. Two, they give the management teams, depending on the size of the deal, somewhere between 8 and 20% of the upside in the company, which is also highly motivating for the management team, and more so than many public companies, particularly if you're running a division versus running a company, you're going to be much more incentivized. So that's two. I think three, increasingly over time, running a public company, you have to report 90 days, and you have every 90 days, and you have to sort of go through this fire drill of getting your stuff audited, going or getting it okayed by the accountants, and reporting your earnings, doing earnings calls, whatever. And it's a big distraction. So if you're private, you basically reclaim, I don't know how many days, 10, 15 days a quarter, that you would otherwise have to spend on, your public investors. So I think those are, and then finally, the other thing that has happened over time is the private equity firms have all built capabilities to help their portfolio companies. And this, generally involves, either functional expertise, like help with sales or help with IT, or industry expertise where, the people doing the deals know an industry really well and can be helpful. So all of those forces operate and have led to an increase in private equity. And then the last thing that's been important is the returns have been good. So this, you get a lot of there's a lot of misinformation out there, and so and this is something to really important to clarify. Some people, when they say private equity returns, and this is true of Ludo Philippou, who's at Oxford, who hates private equity, is they put real estate, infrastructure, energy, buyouts all together, and then they compare that to the public markets, let's say the S&P 500. Well, it's not really an apples to apples comparison. Real estate, you should compare to real estate, energy to energy, infrastructure, to some sort of infrastructure. Buyouts, that's fine to compare to public markets. And when you look at buyout returns, net of fees, to the S&P 500 returns over a long period of time since the early 1990s, vintage years through, let's say, 2018, like never underperformed the S&P 500. I think there were 1 or 2 years it might have, and by small amounts, but it basically outperformed, and that attracted a lot of money. Since 2019, those vintages are underperforming the S&P 500, and that's why you see, there's some headwinds now in terms of private equity, because the performance stopped being so good relative to the S&P 500. It's actually still very good relative to the Russell 2000, which is maybe a better comparison because that's the kind of companies the buyout firms invest in. But buyouts, by and large, did very well. Now, infrastructure and real estate underperformed the S&P 500. And so if you're comparing it to the S&P 500, then those were not good investments, in general. And, that's sort of for me, I don't like infrastructure and real estate for partially that reason. There are other reasons, but some people do. If you want to compare it to real estate and infrastructure benchmarks, then it's a little different, particularly infrastructure. So that's a long-winded way of saying performance was good. That attracted money. Performance was good because the buyout firms, private equity firms, are doing a good job with their companies. And I think they're still doing a good job with their companies. And the two headwinds they have in the last 5 years are the S&P 500 has performed extremely well, and there's more competition on the PE side. So they bid up values of companies, which gives the gains to the sellers rather than necessarily to the PE firms and their investors.
Yeah, I'd love to ask you about where you see this industry 20 years from now. How I learned about this industry. My dad, who you knew, I was a junior at Northwestern, and I got a job at Drexel Burnham. Well, you get a job at Drexel, you go there because that was like Goldman on steroids. My dad, who was a banker at the time at First Chicago, brilliant guy, said, "Hey, Ronnie, there's two people at my bank who I want you to meet because I think it might be an interesting career." Now, when you're 20 years old, you're smarter than your dad, so you don't really necessarily listen. And fast forward, my daughters are 22 and 25, and they don't really listen to me. But what was interesting is I said, "Dad, no, I don't want to meet the people at your bank. I'm good. I got a job at Drexel. Why would I even consider that?" So fast forward 2 years, I go to Drexel. Drexel goes bankrupt. I look back, what was he talking about? He was talking about something called leveraged buyout, which was a precursor to private equity. Who did he want me to meet with? Was Stan Golder, the founder of GTCR, and John Canning, the founder of Madison Dearborn. And then I learned maybe I should listen to Dad a little bit more. So that's kind of how I learned about this. I learned kind of the hard way. You learn the smart way. Where do you think that private equity, from a macro standpoint, because it had headwinds specifically recently, what is it going to look like in 20 years, in your opinion?
That is a good question. So first, let me just say, I read your dad's book. That was one of the first books I read about.
I want to hold.
Dad wrote a book, right? There it is.
I will tell you first. Before you finish, because my dad was my hero, and I loved him so much. When he wrote this book, it's a business book. That doesn't sell a lot of books. We had Crocs and Britannicos. I was so proud of my dad when he wrote the book that I went to Crocs and Britannicos. They maybe had 10 books. And I went to the front shelf. I took all the Daniel Steele books down, and I put his book on the shelf so that you could see it in the count. And then I'm walking down Michigan Avenue with my dad. He didn't know what I did. And "Hey, Dad, look, your book is," and after like a half a second, he's like, "This was you. You did this, right?" I'm like, "Yeah, I did do that." But what was interesting is I always give my dad's book to people, and you were the only person that I'd met that said, "Oh yeah, I have the book and I've read it already." So that was interesting.
No, I think I probably read it when it came out, like 1985 or something. It was one of the books, it was only books about leverage buyouts back in the 80s, and it's still on my bookshelf. I think Ron has seen it there. So now the next 20 years, and again, realized I didn't necessarily get it right beforehand. I remember in the late 90s, after the returns had been very good for many years, I said, I don't think you all can continue getting good returns. And that was wrong. And I think I said that again at a 06 or 07 conference. So now I don't say that any longer. I just say that the private equity investors are very smart. And again, the returns have not been so great for the vintages, particularly 2020 and 2021. So going forward, what do I think? I would say the following. I would say number one, private equity and private capital in general are asset classes that are here to stay. They have advantages that we talked about in terms of governance, incentives, and expertise. I think they also, for the time being, have a regulatory advantage. And that is, what Ron talked about. They don't have to, the reporting requirements are lower and less invasive. And that's a real advantage. Now, the wild card on that is that, you now have a relatively favorable regulatory environment. Under the previous administration, I would say Gary Gensler, if you view public markets as more expensive than being in a private market as being regulated, the current administration, I think, is trying to do this and may do it. So the relative advantage will get lower, but it'll still be less costly and advantageous to be here. The Gensler and Biden administration were trying to do this, and that was just crazy because why impose costs with no benefit? So I was always puzzled, and I think I asked one of the commissioners this. Do you ever do a cost benefit analysis of this? And they didn't. So, and I think the current administration is trying. We'll see what they can do. So the regulatory thing is a wild card that can put pressure on private equity. Well, let's say the regulatory environment remains relatively benign. You'll always have companies where you need, private equity can increase value. Both public companies, divisions of public companies, and then growing companies where they're private, and the founders for some reason want to sell, and then there are also private equity funds are just better off staying private. So all of it, and will be, they'll be there. There'll be reasons for them to be private, for private equity investors to invest in them. What I don't know, and I think is very hard to know, is what the capacity is for private equity versus the public markets, and it's sort of a supply demand question. How much money goes into private equity versus the opportunities to invest in companies where you can justify the fees, which are meaningful, and where you can create enough value to justify the fees. So I'll stop there and let you ask another question.
So before 1985, before you started, you had public markets. 1985 till now, you've had private markets, which have grown into a multi-trillion-dollar industry. And now you've got this thing called family offices. And this one I want to talk about next. I want to talk about family offices versus private equity. And then I also want to talk about the initiative that we're building at University of Chicago Booth, because I think it'll be transformative. But so first question for you is, as private equity and venture capital disrupted the public markets in the late 80s, because it a better model. You don't have to report earnings, the alignment was better, et cetera. Do you think that family offices are not going to replace, they never will, but do you think family offices will disrupt private equity and venture capital in the similar manner that private equity and venture capital disrupted the public markets in the late 80s?
That's a very hard question. My sense is I don't know that they'll be disruptive, in that I think they're complementary rather than competitive. That there will be some businesses where private equity or venture capital makes sense, and then there'll be some places where the family offices will co-invest with them. There's some businesses that maybe are better for the family offices. So I view it more as complementary rather than competitive. And I think that what is true, which is, I don't know if it's disruptive, it's an opportunity, is you now have trillions of dollars in family offices, and you didn't have that beforehand. And that money is probably going to increase over time. As long as we don't get the Sanders-Kana 5% wealth tax, which is annually, which is confiscatory. So assuming there's money that's not taken away by the government, which I will hope is true, you have trillions of dollars in family offices. Some of that will get put to work in public companies, but I assume a lot of the people watching here are here because they're looking at private equity. And I think what some people will do is invest with private equity funds. There are some businesses that maybe can't, like I said before, can't take the fees of private equity, but are have very good returns over a long period of time, and should be private. Those are actually perfect businesses to be owned by family offices over time.
I speak and write a lot about this a lot. Private equity versus family office. And I truthfully believe that in many instances, private equity, it's become an AUM game. The funds have gotten too big. And they're not supposed to make their money on the 2%. They're supposed to make more money on the 20%. But let me ask you this, and I would love to get your opinion, because I feel fairly strongly about this, and I don't know where you're going to come out on this. Today, if a private equity firm buys a garage door company in Des Moines, Iowa, I could tell you, and you could tell them, approximately when they're going to sell it. Not because we're so smart, but because we know how they're compensated. They're going to hold it for 5 or 6 years. They're going to sell it perhaps to a strategic, maybe to another private equity firm. They're going to buy it. We could both predict approximately how long they're going to hold it, 5, 6 years. So over the course of 20 years, this one company is going to change hands, let's call it 4 times. If you look at the taxes and the friction and the disruption in business versus a family office who could simply buy it, hold it, and let it compound, I would argue objectively it is a superior model to do the family office model if you have the right team. What's the argument to that?
So I think that's consistent with what I said, that there are some businesses that aren't going to justify the fees, right? So which is what you're saying, that maybe the first time we fix it and we do a lot of things to improve it, but then the second time maybe you can't justify your 2 and 20 with selling it. Then it's better off somewhere else. Family office is one place where it's better off. And on the taxable side, right, you're competing against, the institutions don't pay taxes, but the individuals do, right? The right. Management teams, and so the management teams might prefer that, although they also might want liquidity. So it's a tricky thing. But I think what you're saying is true. There are some businesses where they're not going to want to get sold over and over again. And if you have a longer hold, the family office has an advantage. The one thing that's a caveat, or that you have to figure out, is the private equity investors are very skilled, and in the family office, do you have the same skills? And because you're competing against skilled people, and if you do have people who are skilled, do you pay them? And so that's really, there's a line, if you pay peanuts you'll get monkeys. So you want to, and this is where family offices sometimes, this is where the friction I see in family offices often is they don't pay their people enough, and you won't get the highly skilled people. So it's that, I think, I think what you said and what I'm saying are the same thing. Is you got this trade-off. The family offices have this liquidity and tax advantage, maybe a horizon. The private equity people maybe have a skill advantage. And there are trade-offs on both sides. You can do this well, you can do this badly. You can do this well, you can do this badly. And the trick is, you want to be, if you're going to do this, you want to do it well. Ditto on this side.
So you've got roughly $10 trillion in assets in family offices today. But the key thing is, and this segues into what we're doing at Booth, there's $124 trillion that's moving downstream from the baby boomers to the next gen. So this is the largest transfer of wealth in history. It's not subjective, it's objective. It's happening as we speak right now. Today, the top kids out of Booth or Kellogg or some of the other top schools, they want to get into private equity, venture capital, real estate, credit. Very few want to get into family offices today. Most of them don't even know what family office is. It's my belief that in 3, 5, 7 years, and then I want to talk about what you're creating at Booth, that the first choice of a lot of the students is going to be to work for a family office and not necessarily a private equity or venture capital firm. What are your thoughts on that?
So I think there's more demand already, or there's demand already, or interest in family offices. I think the students now who are interested in investing and in private markets in particular, they look at, private equity now is a more mature industry, right? It was, it's always been hard to get into, but 20 years ago, it had this tailwind, and now it's a little bit, it's itself mature with, as we talked about, some headwinds. And so the students who want to do this, are not unaware that there's a ton of money in family offices, and that many family offices are professionalized and they have professionalized investors. So they're looking now. Every year I have a few students who go there, and I think you're right. Over time, as there are more family offices that are professionalized, you will have more of the students wanting to go there. And so there's demand now. There'll be more demand. I think the other thing, at least at the business school, where there's clearly interest, is some of our students, their families have family offices, and they're aware of them. They're interested in coursework on it. And then, they talk to their classmates, and their classmates are like, oh, that's an option. So I think it's certainly, I would say, 20 years ago, there was zero. Now there's some, and I agree with you. It's gonna increase over time.
So you helped to spearhead and create the family office initiative at Booth. We were talking about this maybe 4 years ago. Is just like
you nudged me and pushed me, so you get some credit for it. I helped.
I nudged, you executed. I get credit for nudging, you get credit for executing, and Paul Carbone and a lot of other people. But so when we first spoke about it, forgetting the fact that I nudged you, and that's something I'm actually fairly good at. What was it in your mind? Like, how did you envision this? Like, why did you think that creating a family office initiative at a school in Booth is arguably the top, or certainly one of the top business schools in the world? Why did you want to create this? What was your thought process?
I think when we talked, you were making the argument that there's a ton of money already in family offices and more coming. and that there's very little, there was very little instructional material on that. And there was also not a lot of research on it either. And that it was an opportunity to both, help our students and, do research. And so that was, I think that's the compelling reason, is that it's a very big asset class with trillions of dollars. And there's demand from our students, both, who have families have family offices and who might want to work there. There's demand from our alumni, who are in both camps. Some people have family offices. Some of our alums work in them. And then, it's an interesting area to research for a variety of reasons. And so it's sort of a natural thing to have, to have an initiative there. And I think, when you pitched it, 4 years ago, and then, I heard, more or less the same thing from Paul Carbone, who's one of the trustees at University of Chicago. And then John Heaton and I said, yeah, we should think about doing this.
So, what does success look like in 5 years? From Booth's standpoint, what does success look like?
So there's four. Hopefully I can get this right. I think there's four legs to the stool. The first thing is to have some MBA courses, where if you want to go work in a family office, or your family has a family office, you understand the issues involved, and you can learn, how to run it more effectively. So that would be one. Two is taking some of that or all of it to executive education, where we don't provide it for our MBA students, and we also have undergrads and other master students, but we don't have it for our students, but have it for people who are in family offices. So, who are actually doing it, and that might be more advanced. You might also have executive education for family members, so the family members understand, what the family office is doing and how to interact with it. So that would be, one is the students, two is executive ed, three is the network, and we have a very nice family office council of family office leaders. We have an annual family office summit that's coming up, where we get, somewhere between 150 and 200 family office leaders together. So it's building a network for people who are running family offices, where they can learn from us, but also learn from each other. And then the fourth piece is research. So trying to understand, there are a lot of interesting questions on the research. One is, how much is out there? It's very hard. There are various people who try to track it, but it's very hard to know. And then once you identify the offices, how are they governed? What's the right way to govern them? How are they investing? Are they investing well or not? And questions like that I think are interesting, and I think I want to say they're relatively less research and relatively unknown, but it's given the amount of money there, it's an important thing to understand.
Now, Booth was the first, but 5-7 years out, don't you think other top universities are going to create something not identical, but something similar?
No, they're starting, and that's the nature of competition. I think in general, when we've done something at Chicago Booth, we've done it well. So, and we've got I think a very high quality faculty and a very high quality alumni base, if not the highest quality on both, to be able to do this. So, I'm fairly confident we'll deliver something very strong, and then we also collaborate. So we'll talk about it in a little bit. I hope. I'm working on a research project with one of my colleagues, Emanuele Colinelli, with two faculty members at HBS on a family office survey. And so, it's sort of co-opetition with HBS, and but it's a good partner to be working.
Can you talk about that a little bit more, the survey?
So what we're doing, and if anyone listening is interested, you should let Ron know. We are doing a survey of family offices that is going to be a global survey where we hope to sort of do the first serious academic paper that both sort of talks about the landscape of family offices. So we're going to try to cobble together from various data sources how much money there is, how many family offices there are, and then within the family offices, both family offices and multifamily offices, understand questions of governance, investment policies, what they're, the big issues they're facing, and try to put that all together in one place. And we've got, through our various networks, we think this will be a global survey. And, we're in the process of doing it. I think we've gotten, we're well over 100 responses, and, we're hopefully, going to do a multiple of that over the next few months.
So right now, the family office model, I used to think we were in the second inning, then third inning. Sometimes I think we're in the first inning. Only 25% of family offices make it to the second generation, and 10 make it to the third, and 5 make it to the fourth. So the model today doesn't work. It's fragmented, inefficient, and siloed. And you made the comment about compensation, and that's just one of the points. One of the interesting things that I see is that in general, there's obviously the very sophisticated family offices, but in general, if a family office hires a student at a booth, today, most of them look at that as a cost. It's going to cost me $250,000 to hire this student. I can promise you that if KKR, Blackstone, Apollo hires a kid at a booth and pays them $250,000, they don't look at that as a cost. They look at that as a potential $20 million profit center. So that's one of the things that family offices have to get right. So as Booth is looking to professionalize this industry, I mean, what you're really trying to do is all of this money is coming in, and you're trying to take an industry that's fragmented, siloed, inefficient, the model doesn't work, and change the odds and make it work. So other than compensation, what are some other things in your opinion where Booth can help with, from a macro standpoint, making the family office model work? Because I agree that it's a phenomenal model. I agree it's broken right now. What can Booth do to fix that?
I mean, I think for sure, there are two pieces. One is it's educating the principals, right? The part of the reason the family office don't work, or you don't get it to the next generation, is that you aren't optimizing. In some cases, people want to give the money away, so it's not a failure in that sense. But if you're trying to maintain, education is a really good thing for the family members to understand. Here are smart things to do. Here are not smart things to do. And we have a private wealth management executive ed program for a week that's very good for principals to start educating you. And I think that's number one. Number two, educating the students so that they know how to add value, and whether it's their first job or a job that they take after they've been trained somewhere else, I think depends on the family office. Some the very large ones are professionalized already. You may go there immediately. Some of the more mid-sized ones, you may wait, but I think it's education, and it's not just the people running the offices, it's the principals as well.
Yeah, I argue that 85 to 90%, because I've been entrenched in the space for I've got a syndicate of families, we invest together. I've been entrenched in the space for 25 years. And what I see happening, and hopefully we can help to solve for this at Booth, is you have somebody has a liquidity event. They sell their widget company for $100 million, a lot of money. What do? They start investing. Well, first of all, there's no, and that's actually the last thing they should do, because you touched on I mean, one of the things I think you're trying to do at Booth is put together a playbook. So company has a liquidity event. First thing they do is what? Well, something called governance. And then they have to talk about succession, family dynamics, next gen, philanthropy, get an estate planning attorney, and then invest. But what happens now with not all, but the vast majority of these families, they start investing. And if they start investing from day one, they don't have the structure right. And you have to get the structure right too. So that's one of the things you're trying to create at Booth. Is that fair?
That is fair. Absolutely. I mean, it's soup to nuts. And, tax is a huge, as you know, tax is huge, and you shouldn't start investing until you understand all that, and governance as well, which is really, what's your strategy? Who's going to run things? How do you make sure that you don't make, what I would call, everyone makes mistakes, but there are stupid mistakes and smart mistakes, and you want to not make the stupid ones.
And one of the things that we'll have to do is, people will always ask me, you sell your widget company for $100 million. That's a lot of money. It's not enough money to have a family office. In order for it to make economic sense, in my opinion, I've done some math, you really need almost about $500 million in order for it to make economic sense if you're going to invest in private markets and have some sort of a deal team.
If you're going to pay, if you're going to pay someone, who's skilled, if you're going to attract someone who's skilled, you're going to have to pay them a reasonable amount of money. And, at 100 million, can you, going to pay someone $1 million or $2 million? Probably not. At $500 million, then you can. And I think that's right.
And that's one of the things.
And then if you're at 100 million, then you want to, there are certain things you can do. You want to, on the public side, make sure fees are reasonable. And on the private side, then it's there are things you can do there as well.
Okay. We've got a whole bunch of questions from the audience. I want to answer some of them. So we'll put up on the screen first question from the audience that we're getting. Let me see. Can family offices handle such high risk like venture capital? Okay. I would argue today, what I saw happening is post-crash, pre-COVID, all these families wanted to do direct deals. And the thought process was, first of all, everything made money. Post-crash, pre-COVID, private equity, venture capital, real estate, interest rates were zero. It's not hard to make money in real estate. Bitcoin went up, everything went up. 3 years ago, when they started jacking up interest rates, all of a sudden now a lot of the families are not only not making money, they're losing money. And particularly, they don't have the team to go direct, which is something that they're going to have to do. So this question, can family offices handle such high risk like venture capital? What's your thought of that?
Okay, so there are two things you have to figure out. So first of all, there's venture capital funds, and then there is direct venture capital, early stage investing. And so let's do funds first. Early stage funds are risky. It's the sort of variation in returns of early stage funds is much greater than it is for buyout funds, which is greater than it is for mutual funds. So you definitely have a spread of outcomes. So if you're going to do venture capital, you don't want to just do one fund. You're going to need to have some portfolio of funds. So, can you have a portfolio of funds? And you probably can, because there are a lot of smaller funds, 50 million dollar funds, $100 million funds that look for family offices and will take, $1 million commitments. So you actually could diversify across venture funds. They're still risky, but they're there, and they give you some diversification because their returns are going to come at times when some other asset classes may not. The advantage of early stage venture, and why I do some early stage venture, is that for early stage deals, the fund will generally hold them for at least 3 years and probably 5. And for those deals, you get QSBS, qualified small business stock, and the capital gains on your gains, the first $15 million is zero. So if you put $1 million into a venture fund, and let's say the venture fund returns 5x, that would be really good. Let's say 5 million. There's not going to be one investment that returned more than 15 million to you. Your capital gains is largely zero. So there's a real tax advantage to early stage venture. So I kind of like early stage venture, but you've got to pick right, because the difference between good funds and bad funds is huge. And it's just beware that there's that kind of volatility. And the timing matters. So if you came in 20 and 21, when valuations were very high, and people paid a lot of money for deals, and then interest rates went up and a lot of things went down, the 2020 and 21 vintages are not very good. If you, as Ron said, if you invested 2012, 2013, 2015, those vintages are really good because they got to play. There was a low interest rate environment, stock market went up, and there were a lot of good things. Mobile took off, so there were a lot of good things to invest in. So if you're going to do it, realize I wouldn't put a ton of money into one vintage. You want to diversify, so it's all diversification. On individual deals, again, you gotta because it's funds are variable and individual investments are highly variable. You can't do individual deals in venture unless you're going to do a bunch.
Now, you've mentioned taxes, and I want to talk about that because, to me, one of the things that separates the sophisticated, the 10% of family offices that, in my opinion, should exist right now, and the 80 to 90% that shouldn't exist currently as they are, has to do with taxes and what I'm going to call structural alpha. So private credit we'll use that as an example. It's been in the news a lot lately. Private credit is a great asset class, forgetting the last month, but it was a great asset class if you don't pay taxes. If you're an institution, you get 10 to 12%. You're not taking a huge amount of risk, and it was pretty good return. What was interesting is family offices to invest, especially if you live in New York or California, the 12%, if as a taxpayer, goes down to 6.5%, 7%. So after taxes, it's not even a very attractive investment. There's something called PPLI, which is like a wrapper, which you could wrap around it. And to do that, that's something called structural alpha. I put together a conference this year with McDermott and AQR because AQR, they're growing at like $3 billion a month, which is insane. And the reason for the growth is it's beyond tax loss harvesting. They've created something really, really unique. And I think more and more families are getting into that. And one of the things that they said at the conference, which was interesting, we brought about 80 family offices. We went to Sedona for a couple of days. But one of the things that one of the top guys at McDermott said is as many calls as they were getting about AQR and Quantino and those types of firms 2-3 years ago, they're starting to get those calls about ETFs. Thoughts on, do you have any thoughts on that? I mean, I'm talking about from a structural standpoint, that if you put things into an ETF, it's another way to be tax efficient, like PPLI, like what AQR is doing.
Right, that you're not selling it, that it sort of stays in the ETF, and you don't get hit with the gains every time there's some sort of transaction. I am not super familiar with that, but I would say if it works like the way you say it works, it's worth thinking about.
What I could talk for hours, but I know we have to wrap up fairly soon. One of the last things I want to talk about is conferences. I see a question. Ron, do you think the current challenge in private credit has potential to disrupt the private equity market? My answer is yes. You're going to give a more elegant answer. So what's your thoughts, Steve?
I'm, here it's very tricky. So first of all, understand why so much money went to the private credit market. It's because regulators after the great financial crisis in Dodd-Frank and also, in, the Fed and other regulators basically said, banks, we don't want you to be making loans to LBOs. Please get out of that business. So the capital charges were very high, and they really sent the leverage loan business to the CLO market and to private credit to get it out of the banks. It's actually a good thing. So all the money went out, or a lot of the money went out. You have these private credit funds, and it's actually a good place for it to be if it's structured as a GPLP kind of deal, where the LPs give the private credit fund money, and there's a 10-year life to it, and there's no ability to run. And so the institutional direct lending funds are just fine, even when there are downturns. What I think is the issue now is that some of these funds went to the private wealth market or private wealth channel with semi-liquid vehicles, and those semi-liquid vehicles now people are getting nervous about the software and the AI, and you're getting these redemptions, which wouldn't happen in a typical GPLP structure. So there is that's a little bit of run risk. I am that we'll see how that plays out. I think the underlying loans, for the most part, are paying off, and that the private equity and private credit people I talk to say the underlying loans are actually okay. And so you never know what will happen. There's fear there, but I think at the end of the day, it'll be okay. So that's sort of my view on that it's a bit overblown. So Ron and I disagree on that maybe, and we'll see. Again, it's 50-50 who's going to be right. So we'll
You were smarter than me when you went into private equity.
Yeah, but it's like, in investing world, if you're 60-40, you do really well. So, but you're wrong 40%. Even if you're really good, you're wrong 40% of the time. So I am, the older I get, the more humble I get. It's like, I was much more confident and probably obnoxious when I was younger. Now I'm like, I have a view, but I'm, I know I can be wrong.
Okay, so last two things, and then we got to wrap up, that I wanted to touch on are the conference we're having at Booth, and then I just want to touch on AI for a minute, because it's been it's everywhere. The conferences, I keynote a lot of these family office conferences, and the investors that invest with me will say, hey, should I go to this conference? And there's some that I'll say you should go to, but almost always I'll say no. And the problem with the conferences is they're pay to play. They're sponsor driven. And again, I don't judge it. They have to make money. But the problem with many of the conferences is their model is, if you're speaking, you've probably spent 25 grand to be a speaker, and you're really kind of selling your private equity fund or your real estate fund. So it's kind of a pay to play model. That's why I say no. So, but the advantage we have at Booth is that it's the antithesis. So basically at Booth, what we're able to do Tony Pritzker donated $5 million for the professorship, and then we're going to have other people donate more money, so it'll be the so-and-so Institute Family Office Initiative at some point. But we don't have to make money, and that enables us to have Nobel Prize winners and professors like you to just talk about where you think interest rates are going, what's going to happen to tariffs, the global economy, et cetera, without selling. That's a huge advantage. I did a conference, I was at MIT and spoke at a conference recently. I think that the trend is going to be that a lot of the learning from these family offices is going to come from the university level, because we don't have an agenda we're not trying to make money. We're trying to educate. So can you touch on for a minute the conference that we had? How do you think the conference we had last year? I thought it was phenomenal, and the response that I got from other people was really tremendous. How do you think that conference was? And then going forward, how integral will this be in part of the Family Office Initiative, the actual conference we put together?
So Ron, as you know, you're a much better salesperson than I am. So you just did a great job of selling it. But it's true. We made a very conscious, or it's a very conscious decision not to have service providers, and for this conference to be really just family office leaders and academics. And it's a mix of that, where the family office leaders actually talk to each other, and some of the sessions are family office leaders or people of interest. And then some of the sessions are the academics. We've got actually, some of which is related to family offices. We've got a couple that aren't. We've got something on quantum physics and what's happening there. The reaction we had last year was exactly what Ron said. People were like, it was great. We could talk to each other, and nobody was selling us anything. And we actually could, learn some things that we don't learn elsewhere. And it's, I won't disparage, there are many service providers that are very useful and you learn something, but this is different. It's a very sort of, what do I want to say? I mean, the atmosphere, which Ron said, it's very comfortable and kind of freewheeling.
Okay, we just have about 3 minutes left. It's very hard to, how do you do this in 3 minutes? How do you talk about AI in 3 minutes? Rather difficult. But just from a macro standpoint, I mean, I remember when the internet came out, and I mean, when you and I went to college, we had typewriters, right? And my dad was able to afford the one with the whiteout key, the Smith Corona. But we also had computer labs. And you look at the difference between our generation and our children's generation from a technical is you can go back past to the Industrial Revolution. I don't think there's been a bigger change from one generation to the next. Our grandparents had black and white TVs, our parents had color, but the change in technology. From a macro standpoint, and again, I'm just giving you just from a 30,000 foot level in a minute or so, how transformative is AI going to be?
So this is one where, like, I don't think anybody knows. So this is where, I have an opinion. I have a 50% chance of being right. I'm super positive and enthusiastic about it. I think it will lead to productivity improvements, and productivity improvements are a good thing, because ultimately, and every other time we've had a change like this, the living standards go up and people find jobs doing things you didn't know you were going to do. And I think the better analogy for AI than the internet is exactly what you said. It was the PC. Because you and I did I did my college work on a typewriter, and then the PC came out, and you had word processors and spreadsheets. And what happened? The word processors really, hurt secretaries, right? There are far fewer secretaries, and I think it was relatively quick, right? The 80s, there were far fewer secretaries. You would have thought there would be far fewer analysts with the spreadsheet. But in fact, the investment banks, expanded massively, and there were many more analysts and people did stuff with spreadsheets. So I think you're going to see that with AI. There'll be some people who are hurt, and that'll be painful. There'll be some people who are unleashed, and that'll be exciting. But other jobs will come up. The people who were secretaries ended up getting other jobs, and unemployment remains in a reasonable place. So I'm kind of optimistic that you'll get the productivity improvements, and that'll be over time it'll be a good thing. But there'll be some pain and dislocation initially.
Okay, last question. So if people want to A, do the survey, and B, learn more about what we're creating at the Family Office Initiative booth, what's the best way they could do that?
So the survey, they should probably tell you, and you get it to me. And then for the Family Office Initiative, I think just Google it. It's on Chicago Booth Chicago Booth Family Office Initiative, and there's information there. And again, they can also, I think, ask Ron, and you'll know where to direct them.
Great. Well, listen, this has been fabulous. I'm proud to call you friend, and I'm really happy that we've been able to collaborate on this. And I think the execution that you've done has been phenomenal. So thank you for everything that you've done.
Well, you're very kind. Thank you for being the initial catalyst. And it has been great getting to know you over time as well.
Okay, terrific. All right, talk to you soon. Thank you, Steve.